Hey, and welcome to the first portfolio summary video where I reveal my 2 dividend stock portfolios each month. So towards the end of the year in December, I took some time to review the overall performance of my stock portfolios and decided to make some big changes and reallocate holdings in order to prepare for the year ahead in 2024. Usually after a strong rally in the markets, it's a good time to look at your portfolio and see which positions you may want to trim or look at reallocating elsewhere. What happened is that I decided to sell out of 3 holdings and introduce 3 new ones to replace them, which added more diversification, an increase in dividend yield, and also an increase in the total annual dividends of the portfolio. Now let's get into the portfolio and see exactly what I did. So to start for transparency, you'll see here in Wealthsimple the portfolio breakdown between the 2 accounts and the values in Canadian and USD. I'm currently recording this in late January, so there'll be some differences in reports that show later on in the video and the numbers that are shown here. In my non-registered account, which is in Canadian dollars, I have 25 positions with an overall performance of 15.3% right now. In my RRSP account, which is in US dollars, I have 3 positions with an overall performance of negative 5.69% currently. Now going into my non-registered portfolio, which is my main one, from the graph you can see that I actually created this account way back in March 11th of 2021, but did not make any deposits until a year later on July 3rd of 2022, which is just after Canada Day. Not sure what inspired me to start investing suddenly, but it just happened that way. As you can see, in just those 5 months I was contributing quite a lot into the account and managed to put in $31,000 by the end of the year. Now let's quickly go into my RRSP account, which is for retirement and hold my US listed stocks. This one is quite simple and contains some more risky investments, as this will have more of a time horizon of about 30 years before I start using the funds. You can see here on the chart that it only has a one-time deposit of about 5,500 USD, and that's because this is what I had accumulated at a previous job which had RRSP matching. I don't plan on investing more into the account anytime soon, so we'll work with what we have here and see how much we can grow it. Okay, so the focus of this portfolio is a hybrid blend between income and growth, where in the short term I'm focused on accumulating shares for income and looking to grow the portfolio quicker by compounding and reinvesting all the dividends back into the portfolio. Then eventually, when I'm able to, I can then use the dividend income generated by the portfolio to live off of, or just continue to reinvest and grow the portfolio larger. From a growth perspective, it is the longer term play where I'm looking for more capital appreciation and dividend raises for growth. It is still early on in this journey, as I've only been investing for less than 2 years, so as time progresses or new funds are released, things may change. Let's go back in time to a historical report from December 17th before I made the changes and then show you what I did. For you to understand a bit of the context of what I look at when I'm in the spreadsheet, I should give you a quick overview of what metrics I'm most interested in on a daily basis. For starters, the high-level summary section at the top provides a quick glance of the overall performance of the portfolio. Here I want to see the first 3 boxes be green because that shows me the portfolio is actually producing positive returns from my investments. The first box is the daily profit or loss of how the stocks have performed. What matters more is the next 2, which is the total profit and loss and the total return. The total profit and loss is the running total for the entire portfolio as a whole, so this is the amount of unrealized gains from just the stock prices going up or down. Next is the total return. This number is much higher because it not only takes in the 5,311 from the previous total, but it also includes all the dividends I've earned and the gains I've actualized in the portfolio from buying and selling. So if I were to do some quick math and subtract the 5,311 from this total, it means I've received about 4,700 in dividends and buying and selling so far. The next 2 numbers are related to dividends, and the first one is the current dividend yield of the portfolio, and the second one is the projected annual dividends I'll receive each year. Both of these will change depending on the buys and sells in the portfolio, or if there are any dividend changes over time. The next part that I look at and was the catalyst for the changes that I made for 2024 is the bar chart. This compares the performance of the indexes and my portfolio since inception. Scrolling to the bottom, you can see that this portfolio's inception date was July 21st of 2022 and is approximately 16 months old. Now from the chart, you can see that there are 4 bars. OSPTX is the TSX index and the INX is the S&P 500. The capital return and total return values used here are the same as the summary section above, which is the total P&L and the total return. So what this chart tells me is that the portfolio is performing on par with the TSX index in terms of capital return, but is nearly double the return if you look at it from a total return perspective. When comparing the portfolio to the S&P 500, it is underperforming by about 2.5 times from a capital return standpoint, but only underperforming about 4% from a total return standpoint. This underperformance doesn't come as a surprise because most of my holdings are focused on income and growth, which takes time for it to start substantially compounding over time. But looking at this made me wonder what changes I can make to inch closer and close that gap a bit quicker and eventually surpass the S&P 500. With all that context established and out of the way for now, we can get into the more detailed section of the spreadsheet with all of my holdings. I won't go into all the details of each holding for this video because I have a feeling it'll get too long, but it's something we can do in the next portfolio review video. So if you'd like to see that, please subscribe to be notified. As you can see here, I have about 18 of 26 holdings in Canadian companies, which is approximately 69% of the portfolio. The remaining holdings are mostly concentrated in some technology, but are neglecting the overall remainder of the US market. And as we saw in the bar chart before, the Canadian market has underperformed the US market by over 10% since the portfolio's inception. So having this portfolio concentrated in so many Canadian dividend paying companies could be where the problem lies. So doing some research on what funds out there that would provide greater exposure and focuses primarily on the US market or the S&P 500, I came across USCL by Horizon ETFs and decided to look into it a bit more. What this ETF does is it adds a moderate leverage of 25% to its holdings on Horizon's USCC ETF, which writes then covered calls on one of their benchmark funds called HYLD that holds 500 US large cap stocks, so basically the S&P 500 index. The ETF has a dividend yield of approximately 14%, and they only write calls on up to 50% of its portfolio, which means that you can still expect to maintain about 50% growth from the underlying holdings. This type of covered call strategy was not something that I initially focused on building my portfolio around, but it was something that I came to discover through some of my other holdings from purpose ETFs, like APLY, YAMZ, YGOG, and YTSL, and then others like HTAE and TXF. This was not something that was as apparent in HYLD as you can see in the performance in my portfolio compared to those that I just mentioned, and it was probably due to their underlying mix of ETFs initially being a collection of high yielders such as QYLD, RYLD, and XYLD, meaning it provided no upside and full downside while making up 42.2% of the holdings. So when the market is going down, the price of HYLD would follow downwards, but when the market goes back up, the price of HYLD would not be participating in that recovery. So that made it difficult to upkeep the value of the initial capital from investors. They have since made many changes over the past year to reduce their exposure to QYLD, RYLD, and XYLD, and have also just recently started introducing their own yield maximizer ETFs into the holdings, which rate only on 30% of the holdings, leaving 70% upside potential to grow. So with these changes going forward as the market recovers, we can expect the price of HYLD to follow, which is why I've been adding again recently to my HYLD position while the price is relatively low before the effect of the changes in the holdings start to materialize. This is not investment advice, but it's just what I've been doing based on my understanding of the direction HYLD is heading in. Sorry for the tangent, but I feel like this was relevant information that I didn't initially understand, but now has helped me compare and contrast the differences in performances between some of these funds. And I wanted to share some of what I learned along the way during this journey. So circling back now to deciding to gain more exposure to the S&P 500 and the broader US market, I took a look at what changes I can make inside the portfolio to reallocate some of the holdings. So to start off, one of the ETFs that I haven't been adding to and have decided on multiple occasions to try and replace is HDIV. I haven't been as impressed with the returns from HDIV and have been looking for excuses to get rid of it. I know that the performance has been reflective of the TSX and the overall Canadian market's underperformance, but it has always just been around break even, so it was hard to add to it while there were other opportunities, and overall it just felt that capital could be used more effectively elsewhere. Not to mention that the holdings within HDIV are overlapping with many of the individual Canadian stocks that I have, namely the ones inside HMAX and UMAX, and I already own the leveraged version of HTA. Since the decision is to reduce my Canadian exposure and increase the UX exposure, it made sense to take the returns from HDIV and reallocate the position towards USCL. This will provide about a 3% higher dividend yield, more diversification, and exposure to the S&P 500 to possibly close the gap in the portfolio performance. I'll continue to add to this position and make it a significant portion of the portfolio going forward, maybe upwards of 15 to 20%. Since I was already reviewing the portfolio, another one of the holdings in which I had difficulty adding to was FN. It has performed fairly well, providing about 18% in return over the past year, but the stock price itself was never down enough to add to, or there were other more attractive options outside elsewhere to add to. It has a moderate yield of about 6% and is also a monthly payer, so that was definitely a plus. I have to be honest though, my original decision to invest in FN when starting to build this portfolio was mostly due to them being a monthly payer, and that was about it. But looking at the latest dividend increase and also the past history, it's been increasing at about 2% a year, which does not keep up with the rate of inflation. So that was a deciding factor to swap it for something with more growth potential, such as BKCL. BKCL uses the same strategy as USCL, but instead on the Canadian banking sector, containing the big 6 banks equally weighted. So with the overall banking sector in Canada taking a dip in October and starting to see some recovery, the diversification of owning all of them in a single ETF while participating in that upside was more attractive and just simpler. Not to mention it also comes with a 16% dividend yield as well, which is more than double what FN was paying each month. Out of all the holdings in the ETF, I already hold RY and TD in my portfolio, but I don't mind the overlap here as they are consistent growers of their dividend every year, and I've been averaging down all year, so there's upside potential for capital gains. In the near term, I'll be looking to add to this and build it out to a bigger position as the banking sector may look to recover later in 2024. This was another holding in the portfolio that was similar to FN. I originally added this as well because it was a monthly dividend payer, but they changed this last year and became a quarterly payer. Of course I preferred monthly, but this wasn't exactly a deal breaker for me and I continued to hold it. Reviewing the performance of PPL over the past year though, it was one of those positions again which I had a hard time adding to. The stock price was mostly flat for the year, which more so has to do with the energy sector as a whole, but when looking at the dividend increases the past couple years, it's been around 2 to 3%, which again lags the rate of inflation. So looking at Horizon ETFs again, I found ENCL and looked to see what it had to offer. Looking at the holdings, PPL is already inside ENCL, and I already hold ENB, but I don't have positions in the rest of the holdings. The yield of PPL is around 6% compared to 18% with ENCL, so that is a welcomed increase. And ENCL is a monthly payer instead of a quarterly payer. Similar to my reasoning for the other moves, it provided an opportunity to diversify and own the entire sector instead, while being able to participate in the upside when the energy sector begins to recover. So with those changes, I'll summarize the month of December and how the portfolio ended in 2023. This will just be a quick summary as the video is probably getting a little bit too long. Now going to the spreadsheet, and if we go into the transactions section, we can then see what other purchases and dividends I received throughout the month. In terms of deposits, there was $2,900 that went into the portfolio and $573.90 was received in dividends. There were lots of purchases this month, and if you look at the column on the far right, you can see how many of those purchases are in the green or red so far. You'll also be able to see the sales I did and how much profit was actualized for each one. Feel free to pause the screen and take a more in-depth look if you'd like, but let's move into some of the numbers and overall performance. In terms of total return, you'll see at the top that we saw the portfolio grow to just over $10,400 in profit, which is what I would gain if I were to sell everything today. In total, I've deposited just under $68,000 into this portfolio, so I'd say that's quite a fair return, but what makes this a bit crazy is that if you look at the chart for the performance over time, we actually were slightly negative towards the end of October, and then we rallied all the way to the end of the year for these returns in just 2 months' time. Now looking at the bar chart, our capital return is slightly under the TSX, but our total return has continued to outperform the TSX. In comparison with the S&P 500, our capital return is much lower, but that's expected in a dividend-focused portfolio, and what I focus much more on is the total return, which is underperforming by just under 4%, which I hope to close the gap eventually with the changes I've mentioned in this video, and also through the compounding of reinvesting dividends over time as I continue to add to this portfolio every month. For the portfolio's dividend yield, we're sitting at just under 9%, which I'm satisfied with, but would like to see closer to 10% eventually, sometime next year. The projected annual dividends is around $7,000 per year, which is well along the way to my goal of $12,000, which equates to about $1,000 in dividends each month. In the projected portfolio value chart, you'll see that we probably won't hit that $12,000 goal until 2025, but I think we may get closer by the end of 2024. Moving on to the lifetime dividends I've received in the portfolio since we started, we're sitting around $4,600 in about 17 months, or 1 year and 5 months. What I found interesting is that the breakdown of the total return on the portfolio are almost split evenly 50-50 between the capital return and the dividend return. I expect the dividend return to pull ahead eventually due to the compounding and consistent nature of being paid every month or quarter, as it isn't subjected to the swings of the market. As for sector performance within the portfolio, I have 7 categories, and the highest performing ones are ETFs and financial services. The worst performing ones are utilities and communication services, which isn't a surprise as they've been underperforming for basically the whole year. In the next video, you'll see that I change up the categorization a little bit, as the ETFs is too broad, and with the addition of the sector-specific ETFs, more generalized ETF category is no longer accurate. Moving back to the actual holdings page, I'll go over some of the highlights. Enduro Clean Technologies seems to be moving up and growing some legs. It's kind of separating from its previous range of 90 cents to $1.20. I hope it doesn't move too much higher before I can add more to the position. It's kind of just like a small cap play for now. Alimentation Couche-Tard just keeps moving up to new highs, which makes it difficult to add to. I just wish I had added some more back when it was around $60. Go Easy has had an amazing recovery from the lows in May at around $90. Now it's pushing up to $160, which is pretty unexpected considering how low it was. But now I wonder if it can go back to the 200s for its all-time highs. The 2 telecoms I have, which are Bell and Telus, still continue to get crushed, but it's just a matter of time I think before these will recover. My Telus position is a tad high already, so I'm a little hesitant to continue adding more. With that, those are all the major changes I made in December. I'll share more about my RRSP in the next video, so stay tuned. As mentioned, I'm kind of favoring more the sector-specific ETFs for their diversification and ease of decision making. If the sector is down, I can just add more to that one holding, rather than having the dilemma where it might be too difficult to add to certain stocks because they weren't down enough, or there are just other better options to add to. We'll see in time if I consolidate the portfolio a bit more into more sector-specific ETFs and sell off some more holdings. There are already a couple others I'm on the fence about and have thoughts about removing, so we'll see. As a sneak peek into what the January portfolio review will be like, here's a quick preview of the portfolio's performance as of today. If you're looking forward to it, subscribe and like the video. If there's any questions or suggestions, feel free to include it in the comment section below. I'll see you in the next video.